I'm Amanda Han.
And I'm Matt MacFarland with Keystone CPA.
You might have seen us on some BiggerPockets podcasts or read some of our blogs.
We also wrote a book for BiggerPockets called Tax Saving Strategies for the Savvy Real Estate Investor. So check it out.
We are really excited to be talking about tax strategies today. You know, tax savings is not just about paying the least amount of money to the IRS. It has other benefits for real estate investors as well. Now, what if we told you that tax strategies are also ways to help you find hidden cash to grow your real estate faster? Today, let's go over 5 tax tips that will help you find hidden cash for your real estate deal.
Tip number 1, investors are always looking for finding more money for their deals, right? But before you look to, partnering with other people or money partners or borrowing money from other people, why not look in your own pocket, right? A lot of people have, with their rental property portfolio, they've got a lot of equity built up in their properties. So why not look at doing a cash out refi? Because if you do it correctly, those refi proceeds are not going to be taxable to you right now because it's just a loan. And then if you can use that money, those refi proceeds to go and reinvest into more properties, you can continue to build your wealth, continue to generate more cash flow in properties. I mean, that's the whole idea, right?
Yeah. So in your example, if you took out a $100,000 HELOC and you use that $100,000 not taxable to you immediately.
Right. So you're borrowing money, you're going to go out and reinvest it. You're just taking advantage of the equity that's built up in your properties.
Yeah. All right. Let's talk about tip number 2. Now, Matt just mentioned when you pull the cash out refis, you can use it for real estate. The other benefit is that if you're using the refi proceeds for real estate, the future interest on that loan remains tax deductible against rental income. So between the first 2 tips, now not only are you able to access some of that money without paying taxes right now, but also being able to continue to deduct the interest expense. So best of both worlds.
Yeah, and it's going to apply whether you're borrowing from a personal residence, a second home, or a rental property. As long as you're using those proceeds to go out and buy more rental properties, the interest on those proceeds is deductible against those new rental properties that you're buying. So the interest can be tax deductible. So that's why we love that strategy.
Yeah, and the key is to make sure you want to try to use those proceeds for more real estate investments. So whether it's buying new properties or using it on existing rentals or improving properties, but using it for rental properties will help protect you and ensure that you are continuing to deduct that interest.
Now, tip number 3 actually kind of goes the other way around. So we talked about borrowing from a primary residence to buy a rental property. Well, tip number 3 is just to let you know, do not borrow from a rental property to buy a primary residence. The reason being is the interest is not going to be tax deductible in that situation. So it's not deductible because you're not using it for rental properties. And due to some quirk in the tax law, you can't deduct it as primary residence interest because the loan is not secured by the primary residence. It's kind of a weird thing. But so again, don't borrow from your primary to buy a rental because the interest is not going to be deductible. That's the tip.
All right. So we can borrow from our rental to buy more rentals.
Right.
We can borrow from our primary to buy more rentals.
Right.
But we don't want to borrow from our rentals to buy a primary home.
Just buy more rentals.
Buy more rentals. All right. Tip number 4, another tip on how to find hidden cash for your real estate is to use retirement money. Now, your retirement money does not have to be stuck in the stock market with stocks and bonds and mutual funds, although some financial advisors might mislead you to believe so. And the difference is, how do we use retirement money to invest in real estate tax efficient? What you don't want to do is you don't want to take distributions from retirement account. Why? Because when you take distributions, you are likely having to pay federal and state income taxes. And if you haven't reached retirement age, you're probably also paying penalties as well.
Right.
So depending on what state you live in, we've seen times where people pull out money prematurely from retirement account and end up paying taxes and penalties of over 40%. So think about it, pull $100,000, lose $40,000 to taxes, and invest the rest, right? That's not what we want to do. So the tip here is to be able to use that money towards real estate without taxes and penalties.
Right, and the way we do that, so instead of taking money out of the retirement account to use it to buy real estate, why don't we just leave the money in the retirement account and go out and use the retirement account to buy real estate? And you can do that through self-directed retirement investing, right? You just need to work with a retirement custodian that deals with self-directed accounts. So it's not going to be the typical ones that you guys are thinking about, that have stocks, bonds, and mutual funds. It's specific custodians, but you go out and the retirement account itself goes and buys the property. The rents that are earned by the property go back in the retirement account. The expenses of the property are paid by the retirement account. It's a great way to do it without getting penalties and taxes on withdrawing the money.
Yeah, and all types of accounts could potentially be self-directed if you have an IRA, a Roth IRA, or maybe a 401k or 401ks from old employers, SEP IRAs. There's a lot of them that could be self-directed. And the key here is when you do it through that avenue, you're not subject to current taxes and penalties.
All right, now tip number 5 is, what if you have a work 401k and you can't access the money because they won't let you transfer the money because you're still working there? Well, the tip then is to look at borrowing money from your 401k. So a lot of times, a lot of 401ks out there will let you take participant loans. And if they do, you are allowed to borrow up to the lesser of $50,000 or 50% of your account balance. But it's a great way to access the money because once you borrow it from the 401k, you are free to go do and use it however you want. So if you borrow $50,000, you go out as a down payment on another rental property. That's another way to keep your money working for you, keep building your wealth, keep generating more cash flow for yourself.
Yeah. So as you can see, taxes does not always have to be boring, right? It can actually be one of the most powerful tools in your tool belt when it comes to your pathway through financial freedom with real estate investing, right? And since the average American loses so much money to taxes, it's really important that we do what we can to protect our bottom line and have as much to reinvest as possible.
Don't forget to like, comment, and subscribe to the rest of the BiggerPockets series.
Yeah, and make sure to check out our book on BiggerPockets. It's called Tax Strategies for the Savvy Real Estate Investor. If you want more tax information and tax updates, feel free to check out our website at KeystoneCPA.com.